Welcome back to Talk Tickers. Today we have a really fascinating deep dive for everyone.
We really do. It's an interesting one.
Yeah. So we are opening the books on Loma Negra today.
Right.
For our retail investors tracking the ticker, that is LOMA. And we're digging into their Q2 2026 earnings call.
Yeah, and filtering out all that corporate fluff as we do.
Exactly. We want to bring you that classic Talk Ticker style breakdown. So fast-paced, data-forward, opinionated, and most importantly, actionable.
Actionable, right.
Now, Loma Negra, they just celebrated a pretty massive milestone, right?
Oh, yeah. Their 100th anniversary. It was just on August 5th.
100 years. That's wild.
It really is. I mean, a century of operating in Argentina.
Yeah.
That means this company has survived, currency crises, hyperinflation, political regime changes.
Global recessions.
Exactly. All of it. They aren't just a cement manufacturer.
Right.
Their balance sheet practically operates as a direct proxy for the physical and economic development of Argentina itself.
It's like looking at the country's GDP through a concrete mixer.
Basically, yeah. Analyzing their quarterly performance gives us this really microscopic view into the broader macroeconomic realities of emerging market infrastructure.
Right. Which makes their top-line divergence this quarter so fascinating to dissect.
Oh, absolutely.
So, okay, let's unpack this. Looking at the scoreboard, their consolidated net revenue came in at 238.1 billion Argentine pesos.
Right.
Which is a 2.1% increase year over year.
Up is good.
Up is good, but when you look at the actual cement sales volume, like the physical product leaving the loading docks, it actually decreased by 1.4% year over year.
Yeah, that's the catch.
So they are moving less physical product, but driving top-line revenue up.
Exactly.
It's like a bakery selling fewer cakes, but somehow charging significantly more per slice. So their register is still full at the end of the day.
That's a great analogy.
I mean, this isn't selling consumer tech where you can just iterate a premium model, right? This is classic inelastic demand.
Right.
If you are building a highway overpass, you can't just substitute cement with timber because the price went up. You have to buy it.
You have to have the cement.
Yeah. So Loma Negra is really flexing its pricing power to mask what is essentially a shrinking sales pipeline.
Yeah, and that inelasticity is the absolute bedrock of their survival strategy.
Right.
Management refers to this as positive pricing dynamics.
Positive pricing dynamics. I love that jargon.
Right. It sounds great on a call, but in a hyperinflationary or just, highly volatile economic environment, the ability to pass costs down the chain is really the only way to avoid bankruptcy.
You just push it to the customer.
Exactly.
Yeah.
They aggressively pushed price increases through to the market, and those hikes mathematically outpaced the contraction in their physical dispatch volumes.
Right.
However, top-line revenue growth fueled solely by price hikes eventually hits a ceiling, if the underlying consumer economy is hollowing out.
And we definitely see the cracks forming when we move down the income statement.
Oh, yeah, we do.
If you look at the adjusted EBITDA margin, it contracted by 97 basis points, down to 20.2%.
Right.
So they're bringing in more nominal revenue, but they're retaining less of it as operating profit.
Exactly. It's getting squeezed.
But here is where the financial engineering completely distorts the reality for anyone who's just skimming a stock screener.
Oh, this is the craziest part.
Right. Their net profit soared to 7.5 billion pesos.
Wow.
That is up from just $500 million in Q2 of last year. That's like a 1,400% jump.
Which looks incredible on paper.
It looks amazing. But looking at the cash flow statement, this looks entirely like an FX mirage to me. The peso basically stopped falling off a cliff, which saved their dollar-denominated liabilities on paper.
Right.
Like, this isn't an operational win, is it?
No, you are absolutely correct to challenge that bottom line figure. Retail investors really need to understand the mechanics of foreign exchange translation in emerging markets.
It's so tricky.
It really is. So Loma Negra holds U.S. dollar-denominated debt. When the Argentine peso rapidly depreciates against the dollar, the cost to service that debt in local currency just skyrockets.
Because it takes way more pesos to buy the dollars to pay the debt.
Exactly. And that generates massive financial losses on the income statement.
Right.
In Q2 of last year, they absorbed a net financial loss of 22.3 billion pesos.
Ouch.
Yeah, primarily for this reason. But this quarter, because the central bank managed to stabilize the peso's depreciation to a much more moderate crawl, that financial loss shrank to just 5.6 billion pesos.
Ah, okay. So the 1,400% profit explosion is simply the absence of a catastrophic currency hit.
That's all it is.
It's a story of a less hostile monetary environment, not like some sudden leap in manufacturing efficiency.
Precisely. It is a relief rally on the balance sheet.
Yeah.
However, to give management credit where it's due, what's fascinating here is there is one purely operational metric that demonstrates remarkable tactical execution.
Oh, what's that?
Their US dollar EBITDA per ton jumped 14% year over year. It hit $32.10.
Wow. Okay, now that is the metric that matters.
Yeah, it really is.
How do you extract more hard currency value out of every ton of cement in an economy where your local currency is consistently losing purchasing power?
You do it by indexing your commercial strategy to the dollar as tightly as the market will bear.
Okay, so they're tying prices to the dollar, essentially.
Exactly. They're calibrating their local price hikes to actively outpace the official rate of currency depreciation.
Oh, wow.
So this means that even after converting those peso revenues back into US dollars, their operating profit per unit of cement actually expanded.
That's impressive.
It proves that their pricing power isn't just, treading water against inflation. It is actively generating incremental hard currency yield.
Right, which makes the volume drop the central mystery we need to solve here.
Yes.
Because if they're extracting $32.10 per ton, why are they shipping 1.4% less product?
Well, management pointed a very large finger at the sky for this one.
Right, the weather excuse.
Yeah. They blamed heavy April rains for basically washing out urban construction sites.
Now look, whenever an industrial conglomerate blames the weather for a missed target, it usually sounds like a very convenient write-off, just a cover for weak demand.
Sure, it's a classic move.
But looking at the macroeconomic data, the CFO actually brought receipts.
He did.
The ISAC, which is the National Synthetic Indicator of Construction Activity.
Right.
That declined 2.8% year over year in April.
Yeah, and the mechanistic reality of pouring concrete completely validates that data point.
Really? How so?
Well, we aren't talking about, a light drizzle delaying a residential roofing job.
Right.
In heavy construction, like early phase infrastructure and large urban builds, pouring concrete in torrential, sustained rain is structurally compromising.
Oh, because of the water mixture.
Exactly. It alters the water to cement ratio. It weakens the curing process. It basically ruins the structural integrity of the foundation.
You can't just build a skyscraper on soggy cement.
No, you really can't. And beyond the chemistry of it, the logistics completely freeze.
Right, the trucks.
Yeah, heavy dispatch trucks cannot navigate mud-flooded access roads. Work just stops. And when work stops, cement orders are delayed.
That makes total sense.
Yeah.
And the data shows the broader industry cement dispatches were actually down 5% year over year in the quarter.
Right.
So Loma Negra, with its 1.4% decline, actually outperformed the national market.
They did.
They absorbed the weather shock better than their competitors.
Yeah, could have been much worse.
For sure. But let's look at the costs driving that margin compression we talked about earlier.
This is an important piece.
Because consolidated gross margin decreased by 122 basis points to 19.2%.
Right.
And here's where it gets really interesting. A massive driver of this is what I call a regulatory margin squeeze.
Yes.
It's like this permanent, unoptimizable cost floor that was just imposed by the state. They were forced into a $5 million capital expenditure for something called the 25-kilogram bagging project. What is this?
So this is a perfect example of how labor regulations can just instantly alter corporate profitability.
Okay.
Historically, retail cement in Argentina was sold in 50-kilogram bags.
Which is heavy.
Very heavy. That is roughly 110 pounds of dead weight being manually hauled around residential and small commercial construction sites.
Right. By hand.
Exactly. So to improve labor conditions and worker safety, the government mandated an industry-wide transition.
Okay.
Every single manufacturer had to retool their entire supply chain to distribute cement in 25-kilogram bags by a strict deadline.
Which on paper sounds simple, right?
Yeah.
Just make the bags smaller.
Right, until you look at the factory floor.
Yeah. Because if a contractor needs a metric ton of cement, you now have to process, fill, seal, and palletize 40 bags instead of 20.
Exactly. It completely changes the production line.
It literally doubles the packaging material. It doubles the time on the filling line. It increases energy consumption per ton.
Yeah.
And you obviously require more labor to run the upgraded dispatching infrastructure.
It's a massive logistical hurdle.
And they capitalized a $5 million project last June just to comply with this.
Right.
Which means they are now eating the higher depreciation costs on that investment. and that is systematically squeezing the gross margin.
And that operational inefficiency, it cannot be optimized away. You can't out-innovate a mandated bag size.
Right.
The CFO was actually surprisingly blunt during the Q&A segment on the call.
Oh, really? What did he say?
He just flat out admitted that the inherent cost of producing two 25-kilo bags is strictly higher than one 50-kilo bag, purely due to the physics and the extra packaging.
Yeah, that makes sense.
But more importantly, he explicitly stated, and I quote, "The market is not willing to accept that increased cost."
Oof. But they still push price increases through anyway, right?
They did.
Which means they are forcing the cost of this regulatory compliance directly onto a consumer base that is already financially exhausted.
Right.
And that creates demand destruction. It perfectly explains the massive divergence in their customer base this quarter.
Yeah, if you look at the breakdown.
Right. They broke out the performance between bulk cement and bag cement.
Exactly.
Bulk cement, which is transported in those massive unpackaged silos for industrial use, that held strong.
Right, because there's no bags.
Exactly. But bag cement, which represents the retail market like self-construction and refurbishing, that was heavily depressed.
Bagged cement really is the canary in the coal mine for the everyday Argentine economy.
Yeah.
The retail consumer, the small independent contractor, the family trying to finance a home addition, they are the ones absorbing the premium of the new bagging regulations.
On top of broader economic inflation.
Exactly. Meanwhile, the bulk segment is totally insulated. It caters to large-scale infrastructure firms and concrete producers.
The guys who buy the truckload.
Right. They bypass the bagging premium entirely. So it's really a tale of two economies here. Institutional capital is deploying while the retail wallet is closing.
And we see that inflation bleeding into their own operating expenses too.
Oh yeah, SG&A.
Right? Selling, general, and administrative expenses.
Yeah.
SG&A rose to 12.1% of sales.
Yeah.
Management explicitly cited higher salary expenses.
Which is unavoidable.
Right. In an environment where the cost of living is so hypervolatile, unions and labor forces demand constant aggressive wage negotiations just to maintain parity.
It creates this awful margin vice. On one side, you have regulatory capex and depreciation pushing up the cost of goods sold.
Right.
And on the other side, you have these mandatory salary adjustments pulling up administrative expenses.
It's squeezing them from both ends.
Exactly. So the fact that they still generated 20.2% operating margins in that environment, it really speaks to incredibly tight cost controls in the areas they can actually manipulate.
Yeah, that is impressive. But okay, so they're bleeding margin on these 25-kilogram bags. They're getting washed out by April rains.
Yeah.
And they're negotiating constant wage hikes.
Sounds bleak when you put it like that.
It does. If the present is this muddy, what is management pointing to on the horizon to keep investors from just jumping ship?
Well, they leaned heavily on a macroeconomic catalyst.
Okay.
It's called the RIGI regime, RIGI.
Now, wait, is this an actual fundamental shift in their demand pipeline? Or are they just clinging to government buzzwords while they wait for the broader economy to fix itself?
The skepticism is completely warranted, believe me. Government infrastructure promises in emerging markets are notorious for delays.
Yeah, they say they'll build a bridge, and 10 years later, they're still doing feasibility studies.
Exactly. But the RIGI, which stands for the Incentive Regime for Large Investments, it's fundamentally different from a standard public works announcement.
Okay, how so?
It is a targeted, really aggressive macroeconomic framework designed to attract massive foreign and domestic capital into strategic sectors.
Like what sectors?
Things like mining, energy, and technology.
Yeah.
And it bypasses standard bureaucratic delays by offering 30-year tax stability, exemptions from import and export duties, and, this is crucial for international investors, guaranteed access to the foreign exchange market to repatriate profits.
Oh, wow. That's huge for foreign capital.
Yeah, it completely changes the math for them.
Right, because if you are breaking ground on a massive lithium mine, or say expanding pipeline capacity in the Vaca Muerta shale formation, you need an absolute mountain of bulk cement.
A mountain of it.
So RIGI acts as this massive de-risking mechanism for institutional capital, which directly translates into purchase orders for Loma Negra.
Exactly. And CEO Sergio Pfeffman stated they are already working on several of these RIGI-approved projects.
Oh, so they're already in the pipeline.
Yes. They expect them to begin moving physical volumes in the upcoming months.
That's a solid catalyst.
It is. Furthermore, management isn't just relying on RIGI as some solitary magic wand.
What else do they have?
If we connect this to the bigger picture, Pfeffman pointed to a confluence of secondary catalysts. The government recently granted several new road rations, which are in the final stages of pre-construction.
Nice.
They also anticipate a potential easing of monetary conditions as inflation cools.
Which would be huge for the retail side.
Right. That could spur a recovery and credit availability and real wages, potentially reviving that depressed bagged cement segment we were just talking about.
Yeah.
And from a pure calendar perspective, September historically initiates the strongest seasonal demand for construction in the Southern Hemisphere as the weather clears up.
Right. Coming out of their winter. But, you know, I appreciated that Faithman didn't try to paint a flawless, rosy picture here.
He was very pragmatic.
He was. He was incredibly deliberate with his tone. He warned that volume in the first half came in below expectations. And he literally said that the recovery path is unlikely to be a straight line.
Yeah. Acknowledging that volatility builds a lot of trust with institutional analysts.
It does. It shows they're not just wearing rose-colored glasses.
Exactly. And they are backing up that cautious outlook by aggressively managing the levers they do control.
Yeah.
Actually, the most fascinating tactical move of the quarter was their decision to intentionally shut down most of their kilns in May.
Now that is wild. Why would a manufacturing giant intentionally turn off its core production engine during a recovery year?
It comes down to the geopolitics and macroeconomics of the Argentine winter energy grid.
Okay.
Cement kilns are massive rotary thermal engines. They heat limestone and clay to over 1,400 degrees Celsius to create clinker.
Clinker, that's the foundational nodule of cement, right?
Exactly. And that process requires an astronomical amount of thermal energy, typically fueled by natural gas or petcoke.
Okay.
Now, in Argentina, when winter hits, residential demand for heating just surges.
Right. People need to heat their homes.
And the grid prioritizes that residential stability, which structurally drives industrial energy prices through the roof, or it just forces rationing.
So they're essentially hibernating their most expensive equipment to dodge the winter premium.
You got it.
They run the kilns hot in the fall, build up a massive inventory of clinker, shut down the thermal engines before the energy spot market spikes, and then they fulfill their Q2 orders strictly from the stockpile.
Exactly. It is a brilliant hedging strategy. They completely isolated their production costs from the volatility of the winter energy market.
That's really smart.
But the forward-looking catalyst here is how they emerge from this hibernation.
Okay.
The CFO confirmed they plan to restart the kilns in September, and they have already locked in new energy contracts for that upcoming production cycle at significantly better terms than their previous agreements.
Oh, wow. Which creates a massive potential for operating leverage.
Huge potential.
Because if RIGI and the road concessions drive incremental bulk volume in the second half of the year, and they are producing that cement with cheaper, locked-in thermal energy contracts, those fixed costs dilute rapidly.
Right.
That is how you expand margins in a volatile environment.
Right.
You dictate your input costs rather than reacting to them.
Exactly. And it also provides context for the performance of their auxiliary business units.
Right, because Loma Negra is a conglomerate.
Yeah. While cement is the core driver, we have to look at concrete, aggregates, and their railroad segment.
Right. Let's look at those. Concrete revenues plummeted 11.2%.
Yeah, tough quarter.
And volumes were down a stark 18.6%.
Right.
Aggregates fell 10.3%. So what's happening there?
Management attributed that steep drop to a gap in the project pipeline.
Okay.
Several large-scale infrastructure builds, specifically some major port expansions and wind farm installations, they recently reached completion.
Ah, so the structural concrete phases are finished.
Right. And the new RIGI-backed projects haven't formally broken ground yet, so it's basically an air pocket in demand.
That makes sense.
Yeah.
But the railroad segment provided a very interesting counter-narrative to that.
It did.
Because revenues increased by 8.6% year over year, driven by a 10.1% rise in transported volumes.
Yeah.
They own the Ferrosur-Roca Railway concession, which grants them strategic control over critical freight corridors. So they aren't just transporting their own cement.
Right. They are moving agricultural grain and frac sand.
Frac sand is the key there.
Absolutely.
High purity quartz sand is an absolute necessity for hydraulic fracturing. And with the ongoing expansion of the Vaca Muerta shale basin, which is one of the largest unconventional oil and gas reserves on the planet, the logistics of moving frac sand is a highly lucrative ancillary business.
Yeah, it's a huge growth area.
And the volume growth was also unlocked because they finally resumed operations in Bahia Blanca, right? After repairing a critical rail section that was damaged by a storm last year.
Right. However, the cost environment spared no one in this segment either.
Really? Even with the volume jump?
Yeah. Despite the 10.1% volume increase, the railroad's adjusted EBITDA margin flipped negative.
Oh, wow.
It dropped to negative 5.2%, down from a positive 9.8% last year.
Wait, how does that happen?
The top line grew because they physically transported more freight. But the escalating costs of diesel fuel and union labor agreements for the conductors entirely cannibalized the operating profit.
Man. So what does this all mean? We have analyzed the margin squeeze, the regulatory capex, the strategic kiln shutdowns, the delayed promises of government infrastructure regimes.
It's a lot to weigh.
Looking at all this cash flow against the macroeconomic headwinds, what is the final verdict here? I mean, a company can only survive a non-straight line recovery if its balance sheet has the runway to absorb the shocks. With a super safe 1.3 times debt ratio and no debt due this year, are they playing it too safe in a recovery market? Or is this exactly where they need to be?
This raises an important question, right? But honestly, this is exactly why Loma Negra commands a premium in the market.
Okay.
Their balance sheet is a fortress. As of quarter end, net debt stood at $185 million.
Wow. For a company of this scale, generating over 200 billion pesos in quarterly revenue, that is incredibly lean.
It really is. Let's look at the cost of capital context. The net debt to adjusted EBITDA ratio dropped to 1.3x.
Right.
In an emerging market characterized by hyperinflation and prohibitive interest rates, carrying heavy leverage is corporate suicide.
Oh yeah, it'll kill you.
The moment demand dips, the cost of servicing that debt swallows your operating cash flow whole.
Right.
Maintaining a 1.3x ratio means they have virtually no solvency risk. They are completely insulated from domestic credit crunches.
And they actively de-risked the immediate future too.
They did.
In May, they fully repaid their $10 million Class 4 corporate bonds. That completely clears the runway. They have zero structured debt maturities remaining for the entirety of 2026.
None. And management's financial discipline is fully reflected in the cash flow statement. They generated 18.1 billion pesos in operating cash flow this quarter.
That is a staggering operational swing when you look at the historical data.
Oh, yeah.
Because in the exact same quarter last year, they hemorrhaged cash. They posted an outflow of almost 30 billion pesos. So they swung the pendulum by 48 billion pesos into the green. Driven primarily by optimized working capital management and lower income tax burdens, they are running an incredibly tight ship.
They really are. So synthesizing all of this data, the macroeconomic environment, the operational headwinds, the balance sheet strength.
Right.
My stance is cautiously bullish.
Okay.
Functioning as a stronghold for current retail investors.
A stronghold.
Yeah. The primary risk remains the retail consumer. The bag cement segment is struggling under the weight of higher regulation-driven prices and a stagnant broader economy.
Right.
If real wages fail to recover as management anticipates, that high-margin retail segment will continue to drag on overall profitability.
But the upside potential is massive.
Huge.
They outperformed the industry standard during a brutal weather quarter.
Yeah.
They defended their margins through aggressive pricing.
Yeah.
They extracted 14% more US dollar profit out of every ton shipped. They navigated the winter energy crisis through strategic kiln hibernation, locking in cheaper forward contracts, and they absorbed a $5 million regulatory mandate without taking on any new debt.
Exactly. You are investing in a management team that has proven they know how to defend the fortress during volatile downturns.
Right.
Loma is essentially a macroeconomic call option on the physical rebuilding of Argentina.
I like that way of putting it.
If the RIGI regime successfully unleashes institutional capital and infrastructure spending really materializes in late 2026 and 2027, Loma Negra's balance sheet is coiled like a spring.
Just waiting to pop.
Right. They are primed to capture that upside without the drag of heavy debt servicing.
So the actionable takeaway for the retail investor is clear. If you believe the Argentine microeconomic recovery is real, Loma is the vehicle to ride the infrastructure wave. Just prepare your portfolio for the volatility that comes with emerging market turnarounds. But before we sign off, There is a broader industrial reality buried in this earnings call that every investor needs to consider.
Oh, what's that?
We spent a lot of time analyzing management's reliance on April's heavy rains to explain away their volume drop.
Right.
And the national ISIC data completely validated their claim, proving the weather genuinely halted construction.
It did.
But step back and look at the macro-environmental trend. Global weather patterns are becoming demonstrably more erratic.
That's true.
Historic floods, unseasonal freezes, unprecedented storms, they are occurring with increasing frequency. How long can heavy industrial conglomerates rely on bad weather as a quarterly write-off or an excuse for missed targets before erratic climate events transition from anomalous excuses into permanent baseline risk factors embedded directly into their financial models and valuation multiples?
Wow, yeah, it forces a reevaluation of operational resilience. When does an anomaly officially become the new baseline?
Exactly. Keep that in mind as you assess your portfolio's exposure to physical infrastructure and heavy materials. Keep filtering the noise, stay focused on the data, and we will see you on the next deep dive.